Hey everybody, Nathan Beauvais here with some financial context. I want to talk a little bit more about taxes today as we are in the tax season. There are essentially two types of taxes that American citizens find themselves in the presence of. The first is ordinary income tax. Virtually all employees, all self-employed people pay ordinary income tax. And this is the classic progressive tax rate that we have in our country and all developed nations in the world, where the more money you make, the higher the tax rate is on those extra dollars that you're making. IRA distributions, withdrawals from 401ks, these are all subject to ordinary income tax. However, if you have, say, an investment, real estate, stocks, bonds, that are held outside of a retirement account, then any gain that's experienced is actually subject to what's called capital gains taxes. And these rates are lower than ordinary income tax. But there are some caveats that you have to know about. And the most important one is that you have to hold the asset for longer than 12 months. So if you bought a stock and you sold it 11 months later, all the gain that you made there is subject to the ordinary income tax. But if you hold it for 12 months, the tax rate actually drops and can drop significantly depending on what your tax bracket is. The other thing that I find people don't know about and miss a lot is the concept in tax law called stepped up basis. So when you calculate your gain on an investment, you use what you sold it for, and then you subtract whatever you paid for it, and the difference is taxable. Now, if you buy something like a house, for example, and you hold it for 50 years and you live in it your whole life, and you go on and you sell it later on, there could be potentially a large gain there. If you inherit an asset like a house from your parents, for example, you get a stepped up in basis, which essentially means that the basis that your parents paid a long, long time ago gets stepped up to the fair market value on the day that they died. And if you turn around and sell the property a day later, there's no tax because the basis is the same as the fair market value. If they gift you the asset, let's say your parents go ahead and they make you the owner of the house before they die, they also gift you the basis in the property. So that tax is still there. And sometimes the differences here are significant. So whenever you're going to change ownership in a property, whether it be real estate, stocks, bonds, whatever, if you're going to gift that asset to a children, a niece, or a friend, or whoever, it's often very important and prudent to think about the ramifications from a tax perspective. And the best way to get to the bottom of that is to talk to a tax professional.